Is there any chance that the market, as a sort of global mechanism, has gotten too pessimistic, or is it right? Is the wisdom of crowds working?
I think the market is right in the sense that we've seen interest rates move up significantly with the inflationary pressures that we're grappling with. And when rates move up, you get a valuation adjustment. And so we've had that. What you also have is policy, which is uncertain, and policy is going to be uncertain until inflationary pressures start to moderate and we can better size where the Fed funds rate will ultimately have to go. So it's pretty classic the way this is playing out. When bond rates spike and policy is uncertain, you get the volatility. Now, for long-term investors, are we getting a little bit too bearish? Yeah, long-term investors are probably getting too bearish here.
Well, yeah, and this is not the first drawdown we have had. We've got to remember that. Of course, March 2020, pandemic lockdowns, very different situation. I completely get it. S&P fell, I think, about 30%. We've had it back in 2008, 2009. We had it in 2000, 2001. It is painful. It can last longer than we think, but ultimately, those have become opportunities. If you are a longer-term investor, not tomorrow, I'm not talking about next month. That's not long-term. If you are a long-term investor, shouldn't we be looking for opportunity right now for, 3, 5, 10 years out?
Oh, yeah, absolutely. I mean, I was looking, was it Thursday, felt so terrible. That was the 54th worst day of the last 25 years. So as bad as it felt, we've been there 53 or 54 other times. I think I have 54 wrinkles on my forehead to prove that. And when you have those types of downturns, history suggests adding money those days is actually better than pulling money out of the market. So it all goes back to the first principles, which is time in the market matters more. Don't try to time it. Now, people can argue and say, look, in the last 25 years, the Federal Reserve was there to lower rates anytime we got into problems. This is a very different environment.
Correct.
The Fed is raising rates and they're going full bore on it. I get that. The market's pricing that in. It's challenging. It's not fun. But over the long term, betting against the market is betting against the human civilization. It's betting against the things getting better over time. And I'm not willing to make that bet.
Yeah, this is really analogous, it feels like, to 1994, where the Fed raised rates 2.5%. In 95, the Dow did jump 33%. I don't know if that'll happen again. I want to read you a quote in a research note from J.P. Morgan's Marko Kolanovic, came out yesterday. We stay pro-risk with overweights in stocks, he says equities, in stocks and commodities, and underweights in bonds and cash. The past week's sell-off appears overdone, driven to a large extent by technical flows, fear, and poor market liquidity rather than fundamental developments. Now, I highlighted the word liquidity, Brian, on my own because Scott Minerd of Guggenheim told us last week at the Milken conference there is a shortage of liquidity in the bond market, meaning just not a lot of money, and that's the reason we're seeing these outsized swings. He thinks that could also affect equities because the money to buy things or do other trades is simply not there like it used to be because of the interest rate moves. Would you agree with any of that? Some of that? None of that?
Well, I think they're right, and that as investors have fled bonds for the first time in 40 years or so, that's led to this equity valuation adjustment. But we also have to remember what 3% can start to mean for savers. I mean, it's been a long time since we've been able to generate any type of interest in government bonds. And so there will be a captive audience. Now, where do rates ultimately settle? We'll have to see. But what we're going to see over the coming months is a slowdown in economic activity as the Fed tightens policy pretty significantly. So I'm hard-pressed to imagine interest rates continuing to move meaningfully higher, which means investors will find their way back into those markets looking for those more attractive yields. Now, are we at the bottom? Look, there's usually a pretty massive capitulation at the end. We're getting there. Usually by the time you're at the bottom, it's only like 10% of the stocks in the New York Stock Exchange are trading above their 200 moving day average. And right now we're coming below 30, so that's good. Are we all the way there? Maybe not. So there could be more volatility ahead. But yes, for long-term investors, stocks are a better way to play this, and stocks are a better hedge against inflation long term than bonds are. So yeah, that's where investors should be over long terms. It's going to be hard to beat the equity market over the long term.
Yeah, It is up, what, 77% of the time. But when you get that statement, your quarterly statement of your 401k or your investment account in the mailbox, the email box, just hit delete. It's going to look ugly.
Good idea.
Don't look at it.
Good
Move
advice.
on and think long term.